Hello and welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. This video series is where I share my findings about the economy and the markets, usually followed by some kind of a data release. Today, we're going to go over some of the market movers from last week, summary of sort of what happened. And just one topic today. Normally I cover two or three, but just the GDP release that happened this morning at 8:30. So before I begin, there's a usual disclaimer. Nothing you hear in this video is investment advice. Everything you hear is for educational purposes only, and everything is my opinion. Now, if you like this video, please like it at the bottom and subscribe. Okay, let's get started with the market update. Last week, when we started, it felt like it was going to turn out to be a negative week. Previous week was a negative week, and certainly that negative sentiment followed on Monday and Tuesday and Wednesday. We would sort of start high and then we would lose steam and then end up in the red. Um, and frankly, it was led by tech. It was led by tech. It was led by AI fears of lots of different fears. One of them was, oh, valuations are so high. And that does make the markets a bit jittery. But it can also stay high for a very long time. So the markets can be a little bit, depending on the mood, it can decide it's a good thing or a bad thing. The other thing is, will there be a demand for all the data centers we're building? So that was another sort of fear that turned into a elongated sell-off that lasted many days. And the other factor is, all of the debt that we're creating. And I sort of talked about that last week, right? So that continued into the front half of this week. But then Thursday and Friday, the markets recovered. Some of this is sort of par for the course for the markets. Sometimes it sells off and then buyers come in when they feel like it's cheap enough. That's the beauty of the markets, is that there are always buyers and sellers. So, as a market watcher, I just look at the markets, look at the sentiment of the markets, and wonder what's going to trigger either a sell off or a buy the dip, investors coming in. The trigger last week was the inflation data. So I think in the last video, I had talked about the labor market data, but inflation had not come out. Well, Thursday morning, we had the CPI, a belated CPI report that came out. And everyone was expecting it to be around 3%, which was also the previous month's number. Well, previous month being September because of the government shutdown. Um, and it came in at 2.7%. It was low. I believe core came in at 2.6 or something. So between headline and core, it was between 2.6 and 2.7. So it was way below consensus, what we were expecting, and certainly where we were before. So markets were very happy. Well, maybe the Fed doesn't have to worry about inflation anymore, even with all of these tariffs. And therefore, maybe they can continue on their path toward normalization. Now, the markets went up. And then, of course, there was some hesitation during the day because it turned out that 2.7%, while it's better to have some data rather than no data, it wasn't as reliable as people thought, right? Because there were holes in the data that the government was gathering because they were shut down. So there are a lot of assumptions that were made. Some of them were holdovers. So it's a data point, but maybe not as reliable, right? Again, it's better to have something rather than not have something. I wouldn't base any kind of a trend on this. I wouldn't develop any thesis on the trend of the inflation rate in the United States based on this data point. But certainly, it was better than if we had gotten something like 3.5% for the market. So it rallied. And then that rally spilled over into Friday, and then Monday, and then Tuesday, which is today. So I'm recording this at around just before 5 p.m. on Tuesday, December 23rd. Okay, so sometimes you just don't know what's going to completely turn around a market sentiment, which is why a lot of advisors say stay invested and ignore the noise, ignore the volatility. Another thing that helped to buoy the sentiment in the equity markets was the fact that Micron came out and gave a very, very bullish prospect of AI demand. And so that was sort of a reminder to the markets that yes, AI is something to be excited about. And yes, people still want AI and want to develop AI. Because when you get nervous, you sort of have selective memory, right? And sometimes you get nervous and you have confirmation bias and you start believing all the negative things. Sometimes companies and markets remind us of some of the positive things as to why there were investments going into these companies to begin with. Another happy news, and this isn't just good news for tech, it also is good for those of you out there who are users of TikTok. So I don't know if you remember, but for the longest time, there was this push and pull regarding TikTok. Washington viewed it as a national security issue because the owner, ByteDance, is based out of China. And operationally, right, they had a hand in how TikTok operated in the United States. So Washington was very wary of it, whereas I think the users just loved it because its algorithm was very sophisticated. I think it started out literally with dance videos, and now it does a lot of other things. I don't use TikTok, but I have seen it, and my nephew keeps sending me videos from TikTok, so I actually ended up downloading it. Anyway, um, what happened was because of the national security issue, and the sticking point really was the operational influence from China, we needed to separate it. So the US TikTok needed to be separated from China TikTok, right? And so ownership needed to change because ownership can have influence on the operations, right? What happened on Friday was that there was an announcement that a deal had been reached for US owner group. Okay. Now, this wasn't approved by China yet, but the fact that ByteDance was a part of this deal, a very, very small part of this deal, actually it would not have been able to reach that, in my opinion, without some input from the Chinese government. So the makeup is that about 80% is a coalition of investors from mostly the United States and a little piece from the Middle East. And then 20%, just under 20%, is ByteDance itself. Now, ByteDance is a privately owned company and it's owned by another coalition of private investors, some of which include private equity investors from the United States. So I wouldn't see that 20% as entirely made up of Chinese investors. So it looks like it's 20% China, but I don't think it really is. So a deal had been reached, a new ownership or group of owners, and that was really good news for the users. And a lot of market participants were actually happy. Now, one beneficiary of this deal was Oracle because Oracle is part of that group of owners, but Oracle also has a contract with TikTok on providing cloud services and data storage. And now it's really about the security as well, the security of the data per Washington's worry about national security. Okay. So it was a big boon for Oracle. I've talked about Oracle before. It's been an up and down journey for Oracle, this very, very, established company from the 90s. Excuse me. I think we're okay. So I think there was a little bit of a domino effect from that news of, you know, companies like Oracle really benefiting from the deal. And certainly that lifted the sentiment for the rest of the markets as well. So, in all, some good news, both on the economic front as well as investment front. And that carried over to this week. This is a short week for trading, and this is also a holiday week, and therefore trading volume is not very high. That's totally normal. So this market, staying up can feel a little bit artificial, but it's not. It's real. But maybe it's Santa Claus, right? We talk about Santa rallies in the markets in December. So we'll see. We'll see what happens. Maybe we'll have a Santa rally for the rest of the year. We shall see. So let's talk about one topic today, since it is a holiday week for a lot of people. But I do want to go a little bit deeper into that one topic. And that topic is the release of the GDP growth number for the United States this morning being Tuesday, December 23rd. It came in at 4.3% on an annualized basis. We were expecting 3.3%. When that number popped up on my phone this morning, I thought, oh, thank goodness, that's a great number. 4.3% annualized growth is great. Let me first explain annualized. And this is not understood by everybody, and only people who really follow this stuff, like kind of, it's a given to us. Basically, 4.3% doesn't mean from June 30th to September 30th, the US economy grew at 4.3%. That's not what this means. From June 30th to September 30th, we grew at some rate. But if you were to annualize that, on an annual basis, it's at 4.3%, which means for 4 quarters, which makes up a year, if you grew at that same rate all 4 quarters, it would end up being 4.3%. So just so that you understand that we're not talking about 4.3%, in 3 months, because if that happened, then for the entire year of 2025, we would be growing at more than 10% GDP, and we know that's not true. So 4.3%, while we were expecting 3.3%, wonderful. But as you know, leading up to today's video, I've been talking about this K-shaped economy. How is it that we have a labor market that's stalling, that doesn't feel very good? And we talked about some of the weaknesses in the labor market last week. On Friday, we received data on the University of Michigan Consumer Sentiment Survey, and we don't feel good. We feel terrible about the economy. We don't feel good about the affordability part of it. And that is a huge drag on that consumer survey. And a solid 63% of the survey respondents felt like in the next year, unemployment rate is going to continue to go up, which means we don't feel that great about the labor market and for job prospects either. So this doesn't scream at me, oh, this wonderful growth that everyone's experiencing on an annualized basis for 3 months, 4.3%. So what gives? What is going on? Earlier, I said K-shaped economy. That is a part of it. A lot of that 4.3% is being led by a small group of sectors and group of people, et cetera. And the leg that goes down on the K-shaped economy is not doing as well. So there's a bifurcation of a growth and lack of growth in the American economy. Let's break this down. A huge part of the US economy is consumption. We are a consumption-based economy. That's basically you and me going out and buying things that we need, buying things that we want, etc. That came in at, again, annualized basis at 3.5% in the third quarter. That was what carried the day mostly. In Q2, it was at 2.5%. So consumer spending was super healthy in the third quarter. In terms of, let's see, private investment, and this is what I would call business investment. Okay. And that business investment really is, if I have a business and if I buy computer equipment or if I start constructing a building because I want to build an office, which I'm not, but if I were to do that. So anything where there is CapEx is considered to be, that's how I would look at it, business investment. In terms of private investment overall for the economy, it came in at negative 0.2 I'm sorry, that's the contribution. But it was a negative contribution. So in all, if you were to round everything up in terms of business investment, it was kind of nothing, right? Not much changed at all during the third quarter. But if you look into that, AI related CapEx grew at 6.3% on an annualized basis. 6.3%. This is all like computer, research and development, et cetera, et cetera. So we've got consumer spending, which if you were to really go down there, I mean, this is not a part of the GDP report, but we know from retail sales and all the other data that this is also carried by the higher earners in the US population. So that there's a K shape right there. And then even in the business side, we have AI spending really carrying the day at 6.3% on an annualized basis for the third quarter, and everything else is sort of mediocre to down. So, what is down? Okay, non-residential construction down. Let's see, residential construction. This is something I actually do want to talk about. It contracted at 5% on an annualized basis. So negative 5% for the third quarter annualized. And believe it or not, I'm just talking about third quarter, but that is a third straight decline in residential construction. Okay. Now, out of coincidence, last week we heard from two home builders, KB Homes as well as Lennar. And both companies gave us um, not a great guidance outlook on the housing sector. So everything sort of lines up here. I like to line up the corporate messaging with what we're actually seeing on Main Street. So that's sort of where Wall Street meets Main Street for me. And certainly there was confirmation from the corporations that are seeing the consumers hesitant to sign. Even if there's a lot of incentives, people are hesitant to sign to build new homes. So that is both from the corporate side as well as from the government side, telling us that residential housing and construction is in trouble. In fact, I mean, 3 quarters in a row, 5 out of last 6 quarters, I would sort of call that in the recessionary area. Okay. And not surprising, that's where financing is really, really important, right? And speaking of financing, auto sector was also in the negative for the third quarter. Interest rates are high. It's really, and things are not affordable. So of course, those financing related sectors and areas of the economy are going to be lagging, right? So basically, in the business sector, a lot of things were subdued in terms of growth at best. AI carried the day. So another K-shaped economy in the business side. Net exports, we're both positive on exports as well as imports. So net exports came in at around 1.6% on an annualized basis. So that's basically the big picture. From a contribution perspective, and this is the way I like to look at it. So out of the 4.3% total, how much of that came in from consumption, how much of that came in from fixed investment, etc. So out of 4.3, 2.39 was you and me consuming. Okay, so and that's normal. That's normal for US GDPs. Not too surprising. Private investment, nearly flat, negative 0.02%. It's basically flat. Net exports, 1.59%. And then government was 0.39%. So that's the story on the GDP. So despite the fact that the headline number looks really great, 4.3%, to a point where I did a double take when I saw it on my phone, um, underlying data tells you a different story. There's a lot of dispersion underlying that, underneath that headline number that we need to pay attention to, and actually corroborates everything else that we have been observing, both in Wall Street as well as economic data releases. And frankly, it corroborates how we feel, how you and I feel about the economy and what we observe around us. And, I mean, that's confirmation that that is the reality that the United States is in. So We'll see what happens. These numbers will be revised. They should be revised. Unfortunately, because of the shutdown, we didn't get the third quarter GDP growth number in October, which is when we should have gotten it. So normally this month we'd be getting the final number, but this is the preliminary number. So I'm expecting this to be revised. I'm not sure it will be because next month we should be getting the fourth quarter data. Now, fourth quarter is going to be, there's going to be some drag because of the government shutdown. I don't know by how much. But I wouldn't have high hopes for the fourth quarter number, but I would also take it with a grain of salt. If it comes in low, it's not going to be because America is going into a recession or anything. There was a big disruption in the economy called, I guess, like it was like 6 weeks of government shutdown, which is a very long time. All right. That's it for today. Just one topic. Hopefully, you enjoyed what you heard and hopefully, you learned. Um, have a wonderful holiday season. If there's a lot going on or something happens, I will be back next week. But if it's a slow week, and I'm expecting it to be a bit of a slow week, um, I might skip next week. So have a wonderful holiday. And if I don't see you next week, Happy New Year. I'll see you in 2026.